The broadcast is now starting. All attendees are in listen-only mode.
Good day, everybody, and welcome to our presentation with Steen Jakobsen, Chief Investment Officer at Saxo Bank. And today he'll be presenting his outrageous predictions, or Saxo Bank's outrageous predictions for 2019. Before I hand over to Steen, I just want to make sure that everyone can hear me. So if you can hear me, could you please lift your digital hand? It would be the hand icon near or next to your name. Right, I see a few hands. So with that, just some housekeeping. Steen will go through his presentation. You are more than welcome to send questions through the presentation, throughout the presentation, but I will only be asking, or we'll only be addressing them right at the end. So we'll let Steen get through his presentation, and then we'll have a question and answer session right at the end. And with that, I'd like to hand over to Steen. Steen, good day.
Good day. Always a pleasure to be with my good friends in Standard Banks, and they are very smart and intelligent clients. So a rates prediction 2019, of course, already some time has passed for 2019, but as you can see, the theme of this year's rates prediction was very much about Trump. And for good and for worse, of course, Trump remains in focus, as this year is all about the trade deal between China and the US. But the front page I come back to, but I think you can all imagine what that would be about. But let's go into the 10 calls immediately. So the first one, Apple secures funding for Tesla at $520 a share, which, by the way, is $100 more than Mr. Musk was tweeting during the heydays of the Saudi Arabia bid that he thought he had, but did not have anyway. I think the argument here is not necessarily that we think that will happen, but think about it in a big context. Apple is a product platform which increasingly is seeing a need to renew its focus to come up with a new product. On the other hand, Tesla is probably one of the world's worst mismanaged companies with a great technology. So if you think about America first, combining that with the $200+ billion worth of cash sitting of Apple's balance sheet, we are arguing that, for Apple to reach down to the pocket and buy Tesla would constitute less than 1 year's free cash flow in Apple. In other words, it would be a small amount of money for a company like Apple. Of course, this vision of going into other product groups and the likes was very much a Steve Jobs idea, not a Tim Cook. But clearly, both Apple and Tesla is in desperate need of each other, and the marriage between the two could be quite beautiful in the context of making sure that the battery technology that sits with Tesla will remain in the US and Apple will find a new outlet. I would also have to add that on a more practical level, when I travel around the world and I meet car producers, none of them tells me they are producing cars. All of them tells me that they are having a platform. In other words, a company, some Chinese companies that sells 2.73 million cars a year, they see these clients as potential repetitive business. So you may laugh at this suggestion from Peter Garnery, but I think actually in terms of the context, in terms of what it does for the anti-globalization movement, the America first, but first and foremost for keeping the technology in the US, this would to some extent be at least feasible, if not likely. Then number two, of course, as time has passed since Christmas, Prime Minister Corbyn is probably closer to moving into number 10 than he was before. I know a lot of you are concerned about sterling and have sterling assets in your overseas portfolios. What we're really arguing here is that if there was to be a Prime Minister Corbyn, it wouldn't be on his own sort of ability to navigate politics. It would not be because he's the best alternative. It would simply be because there are no alternative. So what we're arguing here is very much what we see and what we saw in Brexit, we saw in the French election, what we saw in the Swedish election, the inability of the parliamentary voice, the democracy to vote into office a governing government. If we take the Brexit issue itself, it's quite interesting that Parliament is saying that they will not move forward because they don't want to be seen not ratifying the voice of the people. At the same time, they are fully incapable of doing this. We think that could leave a huge resentment against the Tory party, a Tory party which in itself has not yet decided what to do. As I'm often saying with a smile, the Brexit talks overall, it's a little bit like talking to my wife, to be honest. She's asking me something, she is saying she wants something. When I give it to her, she wants something else, and then I should have known that in the first place. I think that's very much the position of the UK, and it's very difficult for the EU at large to give concession to the UK as long as they can't even decide themselves, not even in the party of the Tory. We think that leaves an ability of Corbyn to rise to power. Again, not because he's the right choice, not because he's actually getting the political mandate, but he could be the only one standing after the carnage from the extension of the Brexit and the extension forever in the inability to ratify the voice and the vote of the British people. Then the front page, as you probably all guessed, this is, at least in the reality TV show of Trump's world, not unrealistic. He's basically going to Jay Powell, the chairman of the Federal Reserve, you are fired. You will argue that is not a very outrageous call, but it is in itself, because think about it. The global reserve currency, the dollar, is entirely basing its strength, its ability to be transacted. The fact that it's 70% of the global reserves, 90% of all cross-border transactions happen in dollars, is exactly happening because of the independence of the Fed. There is a prior sort of involvement in Federal Reserve policy, and of course some of you would guess that Mr. Trump's hero, Richard Nixon, was the very guy to do that when he sort of forced the Federal Reserve in the 1970s to reverse his course. Some of you may argue that has also happened this year already in the US, where when we saw you down in South Africa in November and December, the Federal Reserve was indicating 3 hikes. We are now talking 1 cut according to the marketplace. But, you know, rest assured, if at any point of time that Mr. Powell is fired, it will be the end of the dollar hegemony power. It will be the end of the dollar as a reserve currency, because although we have a fiat monetary system, the ability for Fed to act on its own is embedded not only in the Constitution, but also in our faith in the US dollar. Then a little bit more up in the helicopter perspective, global transaction enacted as a climate panic spread. You have had excessive weather in South Africa, but certainly in Europe last year, we saw the warmest summer in history. Another few hot summers, and we think that it's very likely that politician goes into panic. They will want to be seen to be acting on the climate agenda. They will want to be reducing pollution. And part of that could very much be that why are we transporting plastic components, very small components, out of China on slow-moving ships that burns a lot of fossil energy at a very high pollution cost? We argue that down the line, airlines and shipping companies, which today is almost free of any global tax, will be taxed exactly on the basis and on the premise that they need to contribute to the pollution they issue themselves. This is very much, of course, a soft sort of projection, but one that will have material impact on shipping and airline industry overall. And here we go along the same lines. IMF and World Bank announced to stop to measuring GDP and instead focus on productivity. Any of you who attended my speeches know you always get a little lecture on productivity being the only thing that counts. The problem with GDP is pretty simple. Let's imagine we have 2 factories, one very pollutive, one very environmentally friendly. Whatever these 2 factories produce in GDP terms will measure to the same amount. In other words, there are no difference in the way a polluted factory and a non-polluted factory contributes to the GDP. However, if we take the full life cycle of the polluted factory, down the line, the factory may stop to produce. The earth needs to be cleaned up. It needs to be adjusted. It needs to have some sort of treatment. and there will be damage to the overall culture. So we need to incorporate full cycle environmental impact into the way we measure productivity. A second strain of this, of course, being that we have a whole new group of millenniums of people around the world who is not focused on growth on its own. They're really more focused about having a better day. The way we see that sort of being played out among consumers is very much the millenniums. They don't want to own anything. They don't want to own a car. They don't want to own an apartment. They don't want to be, tied down by the debt that our generation and the generation before did. What does that mean? That means that we, in the future, will need to measure productivity. All of the incentive structure from the political scene will have to come through the ability to activate, incentivize that we become better at what we do with fewer people, because, of course, a number of countries around the globe, the leading growth in the world comes from countries that have a deficit on demographics. In other words, that there are more people stopping from working than entering into the marketplace. Then a slightly exotic one from John Hardy, who always likes the experiential stuff. But as many of you know, all of the energy on Earth is transmitted through the sun, and the sun exhumes a huge amount of solar flares that in the past, in 1859 was the last incident, created a huge mass that went in and disconnected and ruined all of the telegraph stations at the time. Imagine that happens today with all the satellites and all the things going on. And the cost we say here is about $2 trillion. And if you think this is unrealistic and something out of a space odyssey, let me remind you that Lloyd's actually sells you an insurance against this. And it's very much in their calculation, the 2 trillion is actually too low a price, because I think their estimation in worst case would be $3 to $4 trillion worth of damage from this solar flare. Then this one, which I think is probably the most relevant one and the most likely one. As we wrote this, it was pretty early in November, December. But the story so far in Europe this year is that Italy is already in recession. And we argue that Germany is actually at an even bigger risk of slowing down European growth significantly. Why is that? Well, first of all, Germany is very much a business model that is industrial 3.0. They sell combustion engines in the car industry. The car industry directly and indirectly constitute 25% of their exports. Of course, a car industry that potentially could be at risk from Trump's attack, but overall also, of course, technology under attack because of the move to electric vehicles. In the future, the global sales of cars right now is between 80 and 90 million units a year. When you buy a car in the future, you don't need a new car, you need a new battery. So in other words, I think we have seen the peak demand and peak supply from the factories out of Germany in terms of the number of units of car that will be sold. In the future, we will move along to more electric vehicles that only need one replacement, and that's the battery. On top of this, of course, Germany is a backward economy to some extent. The OECD did a report on internet speed in OECD area. There are 34 countries. Germany ranked 29. With a smile, I can say, I will actually, in my high age of 54, be quicker to get a date in Germany than I will to be on the internet in terms of connectivity. On top of that, Germany is far, and I mean far behind in terms of digitalization, in terms of broadening out the infrastructure investment into electricity, to the ability of utilizing this 4.0 technology of big data and electronics that is coming through the rest of the world. In other words, Germany has been too successful. It runs the biggest current account surplus in the world, but they're doing that because they're not spending money, and not spending money is as evil in economic terms as it is to overspend, as is the case of Italy. So do watch for real, not only in terms of a rate position, but watch how Germany is trading. And then let me end this slide by saying, if you look at the benchmark prime names in Germany, Deutsche Bank goes to the bond market and funds itself at 12% interest rate in a Europe that is actually having negative interest rate. The car industry at large, all the good names like Volkswagen, Daimler, and the lot, trades at multiples of 5 to 6 PE. That is really recession PEs. And if you take Volkswagen, I mean, Porsche, in terms of it as a standalone unit, it's almost worth more than the total capitalization of Volkswagen as a total. So there are opportunities. It's not necessarily neither bad or evil that Germany enters into recession. Actually, personally, I see Germany going into recession and being a huge catalyst for opening up and getting a more long-term sustainable Europe through this crisis. Of course, we all know that debt remains the number one issue globally, and in the history of the world, we have had debt jubilees, forgiveness of debt, as a reoccurring theme. In Europe, the last massive debt jubilee we had was between the two wars, World War I and World War II. In that case, UK was forgiven 25% of its debt, France was forgiven 50%. If you look at the very definition of the emerging market countries, all of the rising nations of the world, what they have in common, they have had a debt jubilee or a bankruptcy inside the last 50 years. So debt jubilee is not occurring in recent history, but throughout monetary history, debt jubilee has been a massive way of resetting the business cycle, moving on with addressing the single biggest topic there is in the world today and for the next 10 years, the amount of debt that we push in front of us at a time where productivity and actual reforms are the smallest ever in history. We think EU could, through a crisis in Germany, through an escalation of the banking weakness that we've seen, create some sort of vehicle similar to what we saw in Sweden in the 1980s, where you go out and securitize, you issue EU guarantee bonds that takes all of the debt from country balance above a certain threshold, let's say 60% of GDP, and amortize that over 100 years. Through that, you activate a higher investment into the economy, you create more jobs and move on. But remember, debt jubilee has been a reoccurring theme forever in monetary history. And this one, which didn't make me particularly popular when I went down to Australia to present the outrageous predictions, we think the single weakest spot anywhere in the world right now is Australia. The Australian housing price is down 15 to 20%. This morning, the Royal Commission, the sort of cleaning up of the Australian banking system commission was out. The market rallied on the back of it. But beneath that, if you have an economy very dependent on four major banks who are under the very, very close attention of the regulators and the government and its customers, do you think they're going to be increasing the amount of credit available or reducing it? Of course, they will self-regulate to lower credit. And this is into an Australian economy, which in terms of credit impulse, the amount of credit created is already negative. So we are arguing that, you know, if things comes to the worst that it could get in 2019, Australia, which calls themselves the lucky ones, could be very unlucky because they, over the last 50 years, basically have been promoting one industry and one industry only, that is the housing market. To mitigate that, we will have a top, basically, where the government goes in and create a huge amount of money to buy up and secure both the banks and the housing market. But also in real terms, do watch out for Australia all year, and in terms of its ability as a benchmark for the world. And this one may not be the harshest headline, but it's actually the one we are the most concerned about. Corporate credit crunches and pushes Netflix into GS vortex. What we're really saying here is that in an environment where the credit cake, the amount of credit available, is shrinking, where the price of money through Federal Reserve action, but also through its indirect action of quantitative tightening, the ability and the drive for central banks to normalize, what will happen is that countries, and specifically companies with a very high amount of debt, will be penalized. That is to some extent what we saw in GE's world in 2018. And we are arguing that if you transmit that into 2019, the companies with the highest balance sheet debt will be companies like Netflix, AT&T. And what they have is a huge amount of debt on the balance sheet, high valuations. But why are they having higher valuation? Because the world, you, me, everybody, is doing what we call passive investments. We are buying more and more index funds cheaper and cheaper. And in doing so, we are not buying Netflix because it's a good company. We're not even buying it because they have good management. We're really just buying it because we are all buying the same stock. And through doing this program of passive investment, we have no opinion about the individual stock, but we will always buy the most expensive stock with the biggest amount of money. That creates in itself a huge potential for a massive sell down if the market were to reverse. We almost saw that in December before Christmas with very little liquidity. But overall, the analogy here is you're at a football match and there's only one exit if that does happen to the market. So that was the 10-hour range prediction. Let me just spend another 5 minutes in terms of the outlook for 2019. So what I'm argued and what I argued when I saw you in South Africa was that the credit cake is smaller, the pieces of the cake are more expensive. It's more expensive to produce because of energy, and the ability to sell the cake in the shop is smaller because of the anti-globalization. What we then replaced that, what we call the four horsemen macro strategy of 2018 with, was the global policy panic. What we've seen over the course of January already and moving into February has been global central bankers, global politicians going into a total panic, celebrating themselves last summer, now pushing to do more fiscal spending, cutting interest rate, and in the case of US and China, absolutely wanting and seeking some kind of deal, sometimes in Q1. And on the China-US deal, let me say, the sources I have in China tells me there will be a deal. We can 100% agree on four things: buying more agriculture product, buying more energy, and buying more and making the currency stronger, and buying more airplanes. Those four things are pretty easy to agree on. What is not easy to agree on, because is the technology space, because China and the US sees the technology aspect of this deal as a critical security issue. Also, think about it, even if there was a deal, how are you going to monitor the deal? Are you going to send US inspectors like you do with the atomic agency into China and control the data and the politics? It would be very, very difficult to do that into the context of a US who do not believe in the World Trade Organization, which in itself is under a massive attack. So what we have argued for the year is sort of the following. We think the market low happened in early January. We stay by that now because the incoming deal with China is positive. We think Fed stop hiking rates in December should ultimately lead to a weaker dollar. We think the Chinese currency will be manipulated stronger. It is part of the deal with China. We are massively overweight emerging market, especially US, China, and as you can happily see to some extent South Africa. We are very bullish on gold, very negative on Aussie. We don't think there will be a Brexit in 2019. We think ultimately the constraint of sterling is not the inability to do a trade, but actually the fact that they have negative credit. As I talked about with Netflix and the overall passive investment, ETF market is the single biggest risk. And in the US, watch out for the biggest risk. So let me end, as I always do with you guys. You've seen it before, but I think it's a beautiful way to end the presentation. 20 years ago, we had Johnny Cash, Bob Hope, and Steve Jobs. No cash, no hope, and no jobs. But I am very, very positive for the first quarter of this year. Thank you.
Thank you very much, Steen. I don't know if there are any questions, but if you do have any questions on the presentation, please feel free to send them through now. Any questions related to Steen's presentation or anything else you'd like to Steen to address. I see, sorry, Steen, that there are some people saying they can hear some background sound. I don't know if you'd be able to just turn that off or close the door.
I'm actually in the middle of a dealing room, so that's quite difficult to move 450 people.
No, it's fine. Okay, Steen, if people have any questions or follow-up requests, can you just share your Twitter handle for them to perhaps tweet you if they have anything they'd like to send to you, or any other ways that they can contact you?
That's a great idea. So my Twitter handle is Steen, Steen _ Jakobsen, Jakobsen. and otherwise try to find me through Saxo Strats. Very happy to take any question as per usual. I know you guys are a questioning bunch, and I always enjoy the Q&A, so feel free to reach out.
All right. We have a few questions now. So first question is from Eddie Wolf, and he wants to know, will cryptocurrencies play a big role in the future?
Oh, the classic question, the crypto side.
Your favorite.
My favorite topic in the world, absolutely. It's actually my second interview this morning, and both of them has been on crypto. So there is a trend there. Maybe that's a sign that Bitcoin has bottomed out. I still stand by what I said. I don't think any of the cryptocurrencies that is in existence today can sustain and transform itself into being the new global asset or reserve currency. What I do think, however, is that down the line, some supranational entity, like let's say the IMF, the International Monetary Fund, may go down the line of issuing a crypto SDR, special drawing right. But the shortcoming we have in terms of crypto today is one, KYC laws needs to be in place, know your client. It needs to be admitted and acknowledged by the central bank, and it needs a huge amount of regulation. So, of course, is there room? Absolutely. Is it going to be a reserve asset in the near future? No. Will it be in the future? I think it's very likely that we will ultimately move towards a cryptocurrency as the reserve currency. But that cryptocurrency will be backed by newer technology, better technology, and of course, support from global governments. Maybe kind of ironic because it's the opposite of how it started off, sort of as a flight from governments.
Okay, thanks, Steen. And the next question from Ian Hall. He just wants you to please explain again why you think the ETF market is the biggest risk.
Yeah, so it's not ETF itself per se, but of course there is some inherent risk in terms of what you buy when you buy an ETF. The problem with ETF is that it is another way of doing passive investment. So in other words, when you buy ETF, you're trying to mirror, you're trying to get an exposure to an index. All of the indexes in the world is capital weighted. In other words, the biggest stock has the biggest amount of allocation. So what happens is that what happened when we all blindly buy ETFs, we are also buying capital weighted, and through buying capital weighted, we buy the market indiscretion relatively to picking out. So in a classic, if you have an advisor, say Standard Bank and others, they will try to sort of deviate slightly from the competition. They try to find an edge in some different areas in terms of allocation. But if we all are doing ETFs, and in the US today, ETFs and overall mutual fund constitute more than 50% of all new flow that goes into equity. We are all buying a capital weighted model as a modus operandi, and through that we are increasing the volatility to the downside, because of course as the market goes up, these ETFs needs to reprice and reset itself by buying more of the stock. But similarly, as we have a move, say, bigger than 15% on the downside, the same ETFs will have to liquidate into a market which is becoming more and more illiquid in terms of market makers, in terms of potential buyers who are scalping and not in the game of passive investment. So robo-advisors, ETFs, mutual funds, risk parity, all of these strategies has one thing in common. They're all buying capital-weighted stocks, which means they are buying indiscretionary relatively to the underlying stock valuations relative to each other. I hope that explains it.
Okay, thanks, Steen. Fred would like to just find out your view on where you see the ZAR and US dollar exchange rates in the medium term. I don't know if you've been.
I lost the second part of the question.
Fred would like to know where you see the ZAR or US dollar exchange rates in the medium term.
Yeah. So, of course, the Federal Reserve weakening its stance, basically taking the biggest 180 degrees turnaround in terms of their outlook that I've seen, indicates that the world and the Federal Reserve certainly is concerned about something. I think what they are concerned about is the lack of treasury buying. The fiscal deficit in the US, the projection of the fiscal deficit in the US has meant that the appetite for dollar is waning among sovereign wealth funds and overall. So there is a slight concern on the dollar. It hasn't yet transmitted into a weaker dollar. But in terms of the dollar SAR, I remain with the view I think I gave you in 2018. I think South African rand is one of the most undervalued currencies in the world. I think the driver here will be partly weaker US dollar, partly emerging markets coming online again with China and the US trade deal. And thirdly, of course, being in election years as it is in South Africa, if we can get through the election without getting too much negative traction on SAR, I think there's a huge rally after as we get more clarity where we see the grassroots in South Africa becoming more and more shared political power base. And I think economically, a lot of the initiative, especially on the improvement of governance that Mr. Ramaphosa put in place, is quite supportive. But overall, short-term dollar, I think market is overestimating the amount of looseness that we see from Fed. So a little bit of strength short-term in the US dollar, but overall for the balance of the year down on dollar direction. And in terms of dollar SAR specifically, I think, of course, I'm nervous into the election, but if I'm talking 12, 24, 36 months, South African rand is top of my list in terms of what I belong.
Okay, thanks. And any views? This is John, who wants to just know if you have any opinions or views on local, so South African and US stock markets for the year.
Yeah, so I think one has to be very careful with this, that we sort of analyze why the market came down in 18 because of this credit cake I talked about. And we also know why it came up in January because we saw Fed turning, we saw the Despo Global Panacea move. I think what we need to consider is even if there is a trade deal from China, and I think for the record that the trade deal between China and US will dictate the full year, both in South Africa and in the US. But if you look at sort of the downside risk here, it is that you, number one, how do you monitor the deal? Number two, the WTO is falling apart. So more and more countries will have to move to a bilateral stance. And thirdly, in terms of practically, technically, the rally we've seen this year is no different what it was in 86 into 87. It's no different from 2000. It could be a bear market rally. But having said that, I am supportive of the market in the short term. I do think there's an 80% probability of a trade deal. And I think the way I see the US market versus the South African market is basically there's a higher beta on the South African market. It has more exposure to the global economy. So the better China and overall does, the better the global economy, the more outperformance you'll get for the South African market. So I'll say if I was based, unfortunately I'm not in Johannesburg or Cape Town or Port Elizabeth, I will probably look for the South African market to reflect my views, not only in the domestic economy, but also the external. I still feel if you want to be long equity, I'd rather be long emerging market or China selectively relatively to the US market.
Okay, thanks. Thanks, Steen. And then I'm going to just combine a question from Grant and Robert. And Robert wants to know, apart from gold, is there any other mineral or metal that you'd be positive on? And Grant wants to know if you have a forecast on oil for the year.
Yeah, so of course I have to make headlines for this presentation you're looking at, but basically the whole spectrum of commodities I think is interesting, all the way from agriculture to platinum. I think all of them has intrinsic value. If you look at long-term upside, I think commodity to S&P 500 has only been this low in the 1930s. So I think overall commodity space, I'm just going to be a good economist to say everything commodity. I'm bullish. The second question, sorry, was on was on oil specifically. So Ole Hansen, who's our oil analyst, is telling me that I should be more concerned about Iran and Iran's sort of ability to come to the market. Of course, they were given waivers short term. We think these waivers are going to disappear. We think increasingly that Saudi Arabia will produce less. We think to some extent Russia will support this. So right now, our projection of oil is actually a slightly higher oil into a higher range. But overall, I think it would be very difficult to exceed 60 in the WTI. And I think the overall, if you take the balance of what is incoming, some short-term upside here, $10 upside, and really $20 downside. So I'm almost a good economist saying I believe both up and down on one hand, on the other hand. But really short-term upside, supply constraints from China, the waivers would disappear, and Saudi is basically producing far less than they used to into a, of course, also slowing demand for oil in the world.
All right, thanks, Dean. And then Mafeno, touching on the Trump, USA, Russia, and China, and he just wants to know the arms race role between Russia, the USA, and China. Do you think it poses any near-term threat to the financial market?
Not in the near term, but certainly, I think a lot of U.S. advisors always said that what is really dangerous is when Russia and China align to strategic interests, especially militarily. And I think that is what we have seen over the last couple of years. A lot of people also felt that India was up for grabs for even the Western countries. What we see increasingly, of course, is that India, through Russia, is now also leaning towards China. So I think basically, and I'm almost embarrassed to say, but I think the arms industry, the arms race is back, and I think it's back in full force. We saw the INF treaty being negated this weekend, and overall, I think the European spectrum of providers will increase. I think the global sort of focus on Cold War, to make it short, is increasing. So in the short term, no, I don't think the market is willing and able to understand the geopolitical frontiers that is being drawn up. But I agree with the question that is implicitly something we need to monitor more closely, in particular because Russia and China now is one front against the rest of the world, which, by the way, also have consequences for the amount of T-bonds being bought in the U.S. and how many people want to use the U.S. reserve dollar. Again, not a short-term issue, but certainly a medium and long-term issue.
Right. And a question from Haroon is your outlook for the global property market. Do you think it's bottomed out?
So I attended a conference in Switzerland a couple of weeks ago with the 100 biggest, at least that's what they claim, real estate investors in the world. And I have to say they did a survey among themselves, not me surveying them, but among themselves. I think 40 to 50% of them thought the market was overvalued and they saw no return in properties over the next 1 to 2 years. And someone has said to me privately, listen, Steen, we didn't want the market to go up this much over the last 2 to 3 years. So globally, absolutely, I think the market is flattening. I think the tightening of monetary conditions is going to be negative. And I think the global inequality reaching out will mean that going forward, the property market will evolve into something where affordable housing, student housing, shelters, and the likes will have a higher social focus. And they'll be built more on that relatively to high-end, high-margin real estate. Having said that, I argue at this conference, I can happily say that some places like South Africa is just dirt cheap because I think the political risk for outsiders is overestimated. People are too concerned about South Africa. I think a lot of you will disagree with me, maybe because I'm a blonde, blue-eyed Scandinavian guy, but I really think South Africa is dirt cheap in terms of property overall. And if there's one market I will buy in, it would be South Africa.
All right, Steen, thank you very much. I think that's it from questions. So we're going to wrap up. Thank you, everyone, for joining us. And Steen, as always, a very, very insightful presentation. Please note that this presentation will be up on the OST website either later today or first thing tomorrow morning. Thank you very much, Steen, and thank you to everyone for joining us, and enjoy the rest of your day. Goodbye.
Thank you.